Welcome to chisME by Money Elementary. My name is Heidi, and we are bringing you the goss on what's going on and down with the financial news.
And my name is Vanessa, and we are so happy to have y'all here today to dive into the spicy world of the financial news for today. So we want to welcome Mia, who is our other co-host. And Mia, would you like to say hi to everybody?
Good evening, Miss Reynas. Mia is here, lashes curled, and data ready. Whether it's inflation throwing shade, interest rates doing the most, or you just want to talk dinero y decisiones, I'm locked in like a chisME group chat at midnight. So, ¿qué me cuentan esta noche? Let's spill the financial tea.
That's awesome. That's exactly what we need to know right now.
Hi, Mia. Can you explain how the feds actually control interest rates and why that matters to everyday people like us?
Oh, yes, Heidi. That's a powerful question. Let Maya break it down for Las Jefas. How does the Fed control interest rates? The Fed's main move is adjusting something called the federal funds rate. It's like the it girl of interest rates. It's the rate banks charge each other to borrow money overnight. But changing this one little rate causes a domino effect that hits credit cards, car loans, mortgage rates, business loans, even savings accounts. When the Fed raises the rate, borrowing gets more expensive. When it lowers the rate, money flows easier, and people tend to spend more. Why does that matter to you? Because it controls your everyday financial life, like a novella villain behind the scenes. Fed cuts rates equals cheaper loans, lower payments, more spending. Fed hikes rates equals expensive borrowing, slow spending, maybe layoffs. Your credit card APR? It's living and breathing based on this rate. Your mortgage? Yeah, the Fed's moves can cost or save you thousands. TLDR, the Fed is like your Tia who controls the thermostat at Christmas. And if she sets it too hot or too cold, everyone feels it.
Hi, Mia. This is Vanessa. The Federal Reserve, led by Jerome Powell, had a meeting regarding interest rates on March 18th and 19th. What was the outcome of that meeting?
Hola, Vanessa. Maya's got the scoop fresh from the Fed. At the March 18 to 19, 2025 meeting, the Federal Reserve, led by Jerome Don Dinero Powell, made a big decision. They kept interest rates the same. The federal funds rate stayed at 4.25 to 4.5%. They're pressing pause, not raising or lowering, because the economy is acting kind of moody. Think inflation, tariffs, and growth slowing down. They also said inflation is still too high, but slowly improving. They might not cut rates until later in the year. They're going to slow down how fast they shrink the money supply, from $25 per month in Treasury runoff to just $5 per month starting April. Translation: the Fed is like, we're watching closely, but we're not ready to party or panic yet.
So she meant 25 billion, but my girl, she's AI sometimes. Like 25 little. She doesn't know how to say the billion with the slash and the per month. So what she was going to say is that they're going to slow down how fast they shrink the money supply. So going from $25 billion a month in the Treasury runoff to just $5 billion a month starting in April. Starting April 1st.
So what does that mean?
What does that mean?
So that means that there is only a certain amount of cash that you can use for loans. So let's say that, for example, we get to 6 billion in April. For those people going over that 5 billion, because the 5 billion is spread out for everybody to get loans. The bank says, hey, we have money. Let's go out and start giving people loans. Now, if they go over that, that means that they're going to start charging premium interest rates. Mm-hmm. So this is actually it's been a while that they've done this. So the news is not really the interest rate. It's what's going to happen if there's not enough money circulating in the system.
Mm-hmm. Do you want to ask our next question to Mia?
Yeah.
All right.
Let's do it. Hi, Mia. This is Heidi. If the Fed is pulling money out of the economy, what signs should I watch for to know if we're heading towards a recession or worse?
Yes, Heidi, you are asking the questions that give economic psychic energy. Here's your Mia forecast. What to watch for when the Fed is pulling money out and the economy starts getting shady. Hash 5 signs we might be heading toward a recession or something worse. Hash 1, rising unemployment. If companies stop hiring or start laying people off, it means they're expecting a slowdown. MIA says watch for big headlines like tech lays off thousands or retail hiring freeze. 2, drop in consumer spending. When people get nervous, they stop swiping the card. Retail stores, restaurants, and travel all feel the pinch. If folks aren't brunching, it's not just about calories, it's about confidence. 3, business cutbacks. Small businesses start saying, we're not expanding anymore, just trying to survive. That usually means less borrowing, lower sales, and fewer job openings. 4, inverted yield curve. This one sounds nerdy, pero es muy importante. When short-term interest rates are higher than long-term ones, it's a spooky Wall Street signal that a recession might be coming. MIA calls this the upside-down churro of doom. Bank trouble or credit freezing up. If banks stop lending or start tightening credit, businesses and people can't access money to grow, spend, or survive. That can choke the economy real quick. Bonus, the vibe shift. If everyone starts using words like tighten your budget, cut back, and uncertainty on the news, that's your cue, amiga. If 3+ of these are happening at once, that's recession energy. If it keeps spiraling, that's depression territory.
Oh, Lord.
Want me to build a recession watch list graphic or turn this into La Caída del Dinero, a drama with collapsing stock markets and weeping economists?
And weeping citizens. Oh, Lord. All right. Hopefully it's not all doomsday,
But let's talk about that, because some of the points that she's bringing up, for example, number 1,
absolutely.
the unemployment. I have been here in Houston. We've been hearing about unemployment on big companies. A lot of the some of the oil companies have been
Medical.
Yep. So I'm seeing that. Which one are you seeing?
Oh, I can't remember the latest one I saw. I know that the Texas Children's Hospital laid off some people.
This one everyone's heard of. If you're in the international parks, like they're letting go of so many national park rangers, federal employees, federal government employees. So the list goes on and on.
Yeah, the vibe shift. I feel like a lot of people are starting to be like, I need to try to save money on even buying groceries. I don't think that we have been at that point. Before it was, let's see where we can cut money on insurance and this and that. Now it's, hey, think I need to start shopping around for my groceries. So that vibe is starting to go in there. Yeah.
And even you told me, and I'm also doing this, like, we need to pay off our credit cards. Because if they're too high, and God forbid, knock on this old table, I lose my job. I don't want to have a huge credit card debt, because then it'll just make it harder for me to live. You know, worrying about how am I going to pay for that? How am I going to pay for the house? How am I going to pay for my car, my insurance? Girl.
So pay attention when the Fed talks. 'Cause when the Fed talks, it does affect everyone, and they meet quarterly.
Yes, the Fed's conversations, we are always going to analyze those because they're full of so much information, and I think that the media only covers the percentage. If the percentage went up, they don't go into the back of the details. Oh, we're going to take out $20 billion in circulation out of the U.S. economy. They haven't heard that one.
In the news. They're trying not to create a panic.
Yeah. They swept that one under the rug.
Like, let's not tell them that. Let's just tell them that we didn't raise interest rates, but they're also removing all this money from our circulation, which is wild. Wild.
Yeah.
But I will say that there is also a separate amount of money set aside for mortgages. So that's not going down. That's actually going to stay the same. It's going to stay at, I think it's $35 billion
Correct.
every month.
Yeah.
So you still can get loans, but the interest rates are still really high on those loans from houses. So there is that, I guess. Bright side.
Yeah. I think it's one of those where they don't want the housing market to bust, right? They don't want to cost another 2008.
Yeah.
But they're like, okay, you guys gotta like cool it down on buying your flashy clothes or this and that. We're gonna put everybody on a budget.
Trips. Me.
Everybody's going on a budget. That's what I feel like they're doing.
Let me go camping a little bit more, even though that's expensive now too. But whatever.
Heck yeah, it is. It is.
Mm-hmm.
Not as much as regular, but yeah.
I mean, we went camping last week and the campsite was like $60 compared to a hotel.
Mm-hmm.
$60 for a night, I think, or was it?
That was I think the entire time there.
So it's
$60.
It is.
a little more cost effective, but the gas to get there and the food and the sous the souvenirs, it all adds up.
You can ask the next question.
Hi Mia, this is Vanessa. Would you please explain to us how money moves in and out of circulation?
Let's talk about how money flows in and out of circulation, aka how the economy breathes. Imagine the economy like lungs. When the Fed wants to stimulate the economy, it inhales and puts more money into circulation. When it wants to slow things down, it exhales and pulls money out. Here's how they do it. How money enters circulation. 1. The Fed buys bonds. It gives money to banks. Banks now have more to lend to you. You buy stuff, businesses grow, jobs go up. 2. Lower interest rates. It's cheap to borrow money. People take loans, swipe cards, invest. That money moves fast through the economy. 3. Government spending. Think stimulus checks, infrastructure, bailouts. All of that goes straight into our pockets. How money leaves circulation. 1. The Fed sells bonds. Banks give money to the Fed. That cash disappears from circulation. 2. Raise interest rates. Loans are expensive. People borrow less, spend less, cool it down. 3. Balance sheet runoff. The Fed lets bonds expire and doesn't buy new ones. That money gets locked away. Telenovela version? It's like Don De Niro opens the palace gates to throw money at the people. But when inflation acts up, he slams them shut and hoards the gold.
Oh no.
Hi Mia, this is Heidi. If I wanted to protect myself financially right now, what moves should I be thinking about while the Fed tightens up or eases the policy?
Hola, Heidi. You're asking the ultimate main character energy question. Let's talk about how to protect your way when the Fed is tightening, pulling money out, or easing, putting money in the economy. chisME's money moves to stay strong in any Fed mood. 1. Build or strengthen your emergency fund. Aim for 3 to 6 months of expenses saved. Tightening equals job layoffs, high interest. Easing equals inflation risk. A cash cushion keeps you calm, no matter the vibes. 2. Pay down high interest debt, especially credit cards. When the Fed tightens, interest rates go up, so your minimum payments can get wild. The less you owe, the more freedom you've got. 3. Keep investing, but wisely. Don't panic sell. When the Fed tightens, stocks might dip, equals good time to dollar cost average. When it eases, inflation might rise, equals consider assets like real estate or inflation-protected bonds. 4. Lock in fixed rates now, if you can. Refi your mortgage. Take out that small biz loan. When rates are still low-ish, secure it before they climb. 5. Watch the signs. If layoffs, inflation, or credit freezes start happening, time to tighten your spending too. Channel your inner abuela mode. Do I need it or do I want it? Bonus. Diversify your income side hustle. Rent a room, sell your candle art, whatever works. More streams equals more stability when the Fed shakes the river.
That's the end of our episode. We're gonna do a chisME
recap. All right. First off, what did the Fed do in March 2025? The Fed paused interest rate hikes and plans to slow down its bond runoff from 25 billion to 5 billion a month to help the economy breathe amid the inflation and tariff drama. This starts in April.
Number 2, how the Fed controls the economy. By adjusting interest rates and buying and selling bonds, the Fed either feeds money into the system, which is called easing, or pulls it out, which is called tightening, which affects your credit cards, your loans, your jobs, and spending.
3. Recession versus depression and the warning signs. Watch for rising unemployment, slowed spending, bank freezing credit cards, and inverted yield curves. More than 3, then we have a financial umbrella that we need on hand.
And then number 4, MBS. Remember this one. It's called mortgage-backed securities. We talked about that. That $35 billion is still going to be in circulation for mortgage loans. Money enters circulation when the Fed buys bonds and exits when it lets them expire or sells them off. It's like opening and closing a financial faucet. So keep in mind that we're losing 20 billion from circulation, but we're still going to have our mortgage security-backed loans, so that the housing market doesn't crash.
And finally, how can you protect your wallet? First, an emergency fund.
3 to 6 months.
Pay down high interest debt. Lock in low fixed rates if they exist. If you have it, yes. Get it
Right now.
Like sometimes you can buy a new car and they're offering like 1%, 2%, or 4% even. If you have the credit, get that car. Don't get some
Don't
ridiculous
wait.
one.
Don't wait.
No.
Not right now.
Keep investing wisely and diversify your income. So get that side hustle on.
Start your Etsy page. I'm going to start selling something here soon. I'm going to start selling my crochets. I don't know what I'm going to do, but I got to do something. There you have it. Updates on the interest rates that went out last week. And when the next Fed meeting happens in the next quarter, we'll be sure to update you all.
Bye.
Toodles. This is Money Elementary.
Money Elementary.
Elementary.
What?
Yeah. All right. Got questions?